course, what a better way to spend your Tuesday evening. And the markets are kind of chopping around. We haven't got any particular direction yet, right? By the way, just give me a sound check if you can hear me. I think we're all good. There's that one time when the microphone wasn't working. There's still bugs. It's like that one trade, isn't it? It just catches you out and you go, double check that. So yeah, give me a nudge if you can hear me. I think we're good to go. We've got the screen share going, got the webcam going. We are good. So markets looked like they were about to sell off, then they've bounced. They've done this, they've done that. Dow looked like it was rocketing through high a few days ago. Now it's back to the midpoint. I mean, you know, I still think it's A to B markets. If you're killing it whole multi-days, then good for you. But I think until we get some direction one way or the other, this year has just been pretty directionless on those markets. Now, you talk about gold, you talk about silver, you talk about metal, slightly different. Okay, today, obviously, cable was pound because of the data that came out that was not particularly bullish, so we say. So it's just, listen, these are the periods you're going. Now, we're going to talk about, obviously, we're going to go into reading losses and learning from losses and stuff like that in a moment. But just a kind of a little point, if I may. Sometimes conditions aren't really aligned with who you are as a trader and your style, and sometimes they are. And you don't know when that's going to come. You don't know how that's going to come. But the main thing is that you've got to live to fight another day. You know, I speak to traders who are very good traders who go through periods where they're like, it's just not working. It's like, okay, well, your job now is not to dig a hole. Now, if it is working, great, you do more. I'm a big fan of putting the throttle down, doing more. But if it's not working for you, your job is to not dig a hole and be patient enough to wait for the conditions or the market or whatever it might be that aligns with the way that you trade. So I'm talking, if you feel like it's 2 steps forward, 2 back, 2 forward, 2 back at the moment, that's okay. Either adjust or just be patient. You know, we won't always have to be hitting things for 6. Okay, so what I want to do first. I want to just remind you, ladies and gents, that we do have FOMC minutes tomorrow. FOMC minutes. We've also got jobless on Thursday. I'm just looking at my other screen here, by the way. Jobless on Thursday. GDP on Friday. Some earnings. We've got Kavana. I know that will be appealing to some of you. Walmart. We've got mRNA. If you're into that type of thing. So, you know, there's stuff happening, but I just feel we just need some direction in one way. Dow looks like it's doing something, then the other NASDAQ looks like it's breaking down and higher. I got cases for both. I'd like to see it resolved, and let's have some kind of multi-day moves. Let's have some calmness. Volatility is contracting. It's just, this is how it works, guys. People just making the decisions of where they want to position. Okay, so before we move on, thank you for the sound check, Richard and Lana. Who have we got in the house? By the way, I have to thank you, because this webinar series is just gone really, really well. Loads of people have registered, thousands have registered, and that's up to, thanks for you sharing it. Now, obviously, Pepperstone are kind enough to allow me to talk about things that I think are going to help you in your trading. And, you know, they give me kind of free reign within reason to say, hey, whatever helps our traders, you can talk about it. So that's great. But I really appreciate you sharing the links and you sharing stuff, and you say, hey, a trader says if you're, serious about your trading, you want to kind of get away from all the other clickbaity stuff, then, Mark's got some things to share. So I really do appreciate that, because the numbers are just picking up, and I don't do it for numbers. I just doesn't really bother me how many we have. I'll speak to one of you, or I'll speak to thousands of you. I'm just glad that traders are getting value from it. So yeah, do appreciate that. So we've got in the let's have a look who we've got. By the way, if you're new here, because a lot of people have shared this link, very quickly, my name is Mark Holstead. I've been trading for 20 odd years or so. I'm not here to say do this, do that. I'm here to share things that I believe work. I've seen work, they've either worked for me or I've seen work with other traders. And that's always where I come from, the perspective of not rah, 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 yes, you must do this and it's the only way to do it. No. I recognize there's different personality types, different styles, different strengths, different weaknesses, different markets, different timeframes, loads of stuff out there. You've got to find your own niche and your own way to trade. I'm always been a big believer of that, and I will always be a big believer of that. And what I share with you are universal things that I think will help you move forward in your trading wherever you may be on your trading journey. So we've got in the house tonight, Aaron, Arthi, you'll be looking at Kavana, we've got Ahmed, Lana, Alison, Andy, and I'm not going to go through everybody. Got 74 on you, and I appreciate every single one of you. I'm going to run through the ones that catch my eye, and that sounds like I'm being favoritism. I'm not. Just Barry, Chandu, Christoph, Dagan, good to see you. David, Elizabeth, Emmanuel, Errol, Felix, Foyle, Frankie, Gary, Graham, Harry, Isaac, good to see you. Karen is here. Kirk's here. Christy's, Lana, Luke, a couple of Lukes, Mark, the Marks, Martin. Tell us you've got an 80s name, guys, without saying you've got an 80s name. Mark is the real 80s name, isn't it? Nina, Pamela, Panos, Pat, Patricia, Paul, lots of Pauls. Peters, Rhino is back in. Rhino, good to see you, buddy. A couple of Richards, Roberts, Robinson, Simon, Susan, Sven, Thomas, Toby, Xerxes, and I missed a few in there. If I missed you, apologies. I'm just skimming through just to appreciate you, and I do appreciate if I haven't kind of called you out specifically, and you don't come here to be like, oh yes, he's called my name. Not we're playing. That's not the game we're playing. Anyway, let's get into the thick of stuff. Today we are talking. No, wait. I nearly forgot. Bulletproof Trader, Steve Ward, great guy. I had him on the podcast a couple of times. Trading psychologist, good bloke, great book. Let me read you an extract. I'm sure he won't mind reading an extract. Working with emotions. A bulletproof trader needs to go through 3 stages in working with his or her emotions. These stages are part of developing psychological flexibility and are based on neuroscientific research into emotions and decision making. Number 1, awareness. Number 2, acceptance. And number 3, action. Now, there's a lot of stuff here, so I'm going to paraphrase a little bit. So what he's basically saying here is, number 1 is awareness. And I've always talked about self-awareness. If you can be self-aware as a trader, you can recognize these emotions before they hijack your decision making. Are you being hesitant? Are you being overconfident? Do you have FOMO? All the classical stuff, right? And so Steve says this: a simple first step is to start adding information to your trading journal about how you feel during your trading process. Record how you are feeling. 1, the start of the day. 2, as you prepare trades. 3, as you enter the market. And 4, as you manage your positions. 5, when you exit. And then the final one is when you reflect upon your trades. So it goes on. There's a lot more context there, and this is a great book. I do recommend it. But that's the awareness phase, just understanding why you think the way you think. 2 is accepting the emotions are just data. So he says exactly that. Accepting emotions are data. What emotions do you fight? And he goes on to kind of going into some depth here and saying, hey, are you stressed? Are you feeling, what's the feeling there? But recognize it as data, just like price data, just like your indicators, if you're using indicators, it's data. And then the third thing that's part of that process is the action. So summarize stuff here. The goal was not to eliminate emotions. He was talking here about the Stoics. The goal was not to eliminate emotions, but to not get overwhelmed by them or to be forced to act them out. So lots more depth there. Definitely go and have a look at that one if you can. But the point is simple and clear. It's like, listen, be self-aware enough to recognize the emotion. 2, then you kind of observe the emotion. You say, okay, well, what is data? What do I do with it? And then the third thing is, right now, what's the action do you take? Often that's calming yourself down. It's just, a lot of people talk about suppressing emotions and training like a robot. It just doesn't work, right? You can do that for a while, but you're a human being. And why take out the human element of trading? We want to enjoy it. We want to have fun while we're doing it. If you're going to be in this business for multiple years or multiple decades, what sort of life is it if it's just drearily going along? You want to enjoy it. Now, sure, trading's not milk and honey, land of milk and honey and all excitement all the time, and obviously you don't want to be trading for pure excitement. You're not gambling and getting a dopamine hit from that. But at the same time, you enjoy the journey, but recognize the emotions are data. Anyway, Steve does a better job than I have of kind of going through that. That's well worth a read or listen. Or if you listen to the Traders Mastermind podcast, he talks a little bit about that as well. Okay, so let's get into the thick of stuff, guys. So today we're talking about failure analysis, reading your losses correctly. Correctly will all become clear in a moment. Jesse Livermore, great quote: the game taught me the game, and it didn't spare the rod while teaching. So before we continue, of course, I've got to do the risk disclaimer. If I can click on the right window. So if you're trading leverage, you're trading on margin, please understand that it's a double-edged sword. You can lose a lot of money very, very quickly. If you appreciate that, you accept that, you do things to manage your risk, you use stop losses, you accept and understand slippage, gap risk, all the other stuff that we know and love as traders. If you can understand that, accept that, then there's the upside that comes as the counter to that. You know, it's that balance, right? You trade with leverage, trade with margin. It's going to do some good, have a good impact on your account if you're right, but not so if you're wrong. So just please, I know you all know this already, but I want to say this: just understand the product and instrument you're trading. You're trading a spread base, trading a CFD, whatever financial instrument you're trading. Just thoroughly understand how the thing works, and whether the money you're deploying, you're happy with that risk. So understanding your risk parameters, what you're doing, how you're doing it, and the product you're trading, the markets you're trading, the risk in trading, the gap risk, all of the stuff that comes with it. If in doubt, take a step back. Demo accounts are there for a reason. Take things slow, take things small. You don't have to be a hero from day one. If you are serious about the trading, then there's some longevity and take your time with that. Okay, that being said, let's get rolling. Okay, so if we could define this problem, and by the way, some notes very, very, very briefly. Anything I kind of say here, I know you know this, but I don't want this. This is not, we're not talking literally a lot of the times. There's a big gray area in trading, and that I think is where the alpha lies, to be honest. That's probably a topic for a discussion for another day. But you know, we can't solve trading. If I do this, then I'll do that. If this, then that. Now, there are some aspects where that makes sense, right? If you have your max loss limit for the day, you quit. It's a binary thing. You should do that. You should make sure you do that. But there's certain things where, you know, today we're going to talk about losses and learning from your losses and reading into your losses. I don't want this so taken so literally, like, well, Mark said this loss should be doing this. Like, listen, we're generalizing and we're trying to have kind of broad context of how to perceive losses, and we'll see in a moment. I won't get ahead of myself too much, but I kind of noted down that, you know, trading is not black and white. In some instances, they're right. The day loss limit is perfect. It's black, it's white. You're over it, you're done. Add done for the day. And sometimes you might have a system that's, if the price breaches this level, I'm long, and fine. A lot of traders thrive on that, but there is a big gray area of, it could be this, it could be that. I don't want to take it too literally. It's a broad approach. It's a rule of thumb. It's a model. It's a tendency. These things are difficult, I think, for humans to deal with a lot of the time, because we want to put things into nice little neat boxes, right? We want to say this is this, this is this, this is this. And trading isn't really like that. You can get so far by doing that. Sure, you can. But to get to a decent level, you're going to have to accept a lot of gray and a lot of kind of, well, that's really the theory, but sometimes it's this, sometimes it's that. So, you know, today's a great example of this. All will become clear in a moment. But generally speaking as well, you know, the black and white nature of trading doesn't exist everywhere, but embrace that, because that's where the edge is. If it was just black and white and it was just very, very simply put like this, it's either true or it's false, then it would be solved, and we wouldn't be able to trade, because there would be no, I believe there'd be no edge. It's that gray area, the human psychology, understanding how price moves, understanding why traders are trapped, you know, that we kind of look into as traders and go, okay, what's my best judgment on that? I guess the analogy would be, you know, if you're driving a car, right, there are some rules of the road and there are some rules of operating the vehicle, but there's certain gray area, and there's certain stuff that you build from intuition. There's certain stuff that you might break a rule, a strict rule, but it's the right thing to do at the time. You know, if you're overtaking someone, you're going to stick to the speed limit exactly to the miles per hour? Probably not, because that oncoming HGV is going to smash through your windscreen. You're going to get past, and yeah, fine, there might be a few hundred yards where you broke the speed limit, but in that context, that was the right thing to do. Pulling out of a junction, you might want to use maximum acceleration when you can, and you know, maybe you end up kind of breaking the speed limit there, but that's safety. There's all sorts of things in navigating. Maybe you kind of you're in the wrong lane. You get the idea, right? There's always that gray area, and if you're a driver or any other kind of thing like that, you understand. So trading is a lot like that. You know, a lot of people try to oversimplify it, and of course there is room for that. And depending where you are on your journey, there's a simplification of trading. Of this is what I do in my plan. I look for this. I follow this. Absolutely, you should do that, and that's probably the right thing for a beginner. If you are more intermediate, you've got some years under your belt, you've got some screen time under your belt, now's the time to embrace the gray. Now's the time to embrace the, oh yeah, okay, this is a theme, this is an idea, but not set in stone. And I know that sounds a bit flaky and stuff, but I promise you, that's, if you can embrace that, the unlock is huge, I believe, because you start not looking for an exact answer. You go, well, yeah, that's broadly what I'm trying to achieve. Okay, so that makes sense. The problem, so every trader loses, right? We know this. You know, if you come on here think every trader you're going to win every trade, then you wouldn't be here. I know you wouldn't be on this webinar. It wouldn't excite you. You would be excited more about 100% win rates, make all this money in a short period of time type of thing. But you know the real deal, right? And you're in the trenches. You're trading every week, maybe every day, and losses are part of the game. It's part of the business. So the issue we have is not the loss, right? It's what we do after we lose. Now, again, I'm really drilling into something. I don't want to take it too literally, and you kind of see what I mean in a moment we go on. I'm not saying every single loss needs to be super examined and and it's this and that, the other, but you'll see the tendency. So most traders, we either do this, we either go, it's just a loss, doesn't matter, or the loss becomes something that we get attached to. That loss is the final straw, and we get frustrated, we have self-doubt, maybe we have a revenge trade. It's normally not one loss that does that, but let's be honest, you never normally do that after a win. So it's normally the loss that's the trigger to create these emotional trading environments, or this over analysis on the next one, or oversizing on the next one. It's normally the loss that's the kind of final straw that breaks the camel's back, so to speak. And sometimes you look at loss and you just shrug your shoulders, and maybe you're a trader who kind of just goes on, moves on. So loss is a part of the game, loss is a part of the game, loss is a part of the game. Two ends of the spectrum. Loss is the part of the game, don't care. And oh my God, every single loss hits me right in the solar plexus. I need to do something about it. There's a middle ground. And this is what we're going to kind of talk about today, is kind of learning from losses, interpreting losses when it is signal, when it isn't noise. Because not every loss tells you the same story. So listen, most people don't care about the financial aspect of losing a trade. And obviously risk management and understanding position sizing and that type of stuff should be at the forefront of your trading model, and you should accept that, and I'm sure you do. And so when you take a loss, it's not going to be damaging. And if you do, by the way, then you're trading too big. If that single loss is damaging to your account, or damaging to your heart, or damaging and making you feel uncomfortable, then you are absolutely trading too much size. That's a by the by. Most of us kind of understand this, and so you don't really bother about one individual trade. It's money. You just say, okay, I know I've got to lose, and blah blah blah. It's 1R. I'm looking to make 2R. I get the maths of how this works, but potentially the damage happens after the loss. You start to look back on it, and you can, if you're not careful, do one of the two things that I said. You either abandon the way you trade and kind of just change course dramatically, or you just keep operating the same thing, going, you know what, it's just a loss, I'll keep going. And this is where we're trying to interpret as much data as we can from a loss. Now, I'd say the word loss, but later on you'll see I mean a cluster of losses, and we're looking at like a larger amount of data. But what we're trying to do is we're trying to work out, hey, I'm losing, why? Why am I losing? Because if you can identify that, then you can fix it. And the problem you have is when you misdiagnose it, and hold my hand up here, I've misdiagnosed this so many times in my career, where I've gone, oh, it's this, and I haven't really thought about it. I haven't really looked at it and gone, you know what, it's not that, it's this. And I'll tell you what this is. So I think you've got 3 pillars, or 3 buckets, 3 categories, shall we say. Let's keep it in line with what I've written here. You've got clean, normal losses. Cost of doing business. No trading strategy has got a 100% win rate. It is what it is. You followed your process, everything was good. Execution failures. This is where you made a mistake in how you executed the trade. And a structural failure is that setup or strategy is no longer valid. So let's talk about clean. Let's look at a little bit more detail here. So we want these type of losses. We want what we're going to call from now on clean losses. This is that you followed your plan. This is that the setup was valid. It ticked all the boxes. The entry was good. The stop went where it should be. It was a textbook trade. The market just didn't go your way. But that's trading, right? We're not trying to win every trade. We know we can't possibly win every trade. And so we accept the fact that we're going to lose some trades along the way. That's the cost of doing business. We always talk about the casino model, right? The casino offers a game up for the public to play, and they have a slight edge there, and they know that over time that edge is going to play out and they're going to make money. They don't care about an individual hand of blackjack. They don't care about an individual spin of roulette. They just know, hey, over time, we know that with X amount of games played, we're going to come out on top. So we are trying to do that as traders. We're trying to say, hey, we believe we have a positive expectancy over time. We don't know how that's going to come out in the wash, but we don't care. We just want to keep playing that and keep playing that. And I recognize that it's different in trading because assigning a probability to a trade is difficult. Assigning a positive expectancy to a trade or an outcome or how much we expect is very, very difficult, right? It's not like a fixed odds game like blackjack is or roulette. So it's challenging, but that's what we're trying to do. And we should respect the fact that it's a cost of doing business. An edge is just an edge. It just means you have, over time, you're going to make money out of the market, whether that's an RVR edge, whether that's a win rate edge, or whether that's a little blend of the two, as we talk about quite a lot. You're going to lose, and it's fine. And we just carry on. We just carry on with that and just run the process, run the game, keep going through. If a clean loss bothers you, then your size is too big. And we're going to talk about how we identify this in a moment and go through some kind of operational tactical things that may help. But what we want to just get in our minds first before we move on here is if it really bugs you and you've stuck to your plan, you've done all this, everything's correct, then you're trading too big. It's just an emotional trigger that's gone on. You've gone, that's hurting. It shouldn't hurt because everything else is lined up, excuse me. So make sure the sizing is correct. There's not a conversation about sizing, but it's worth mentioning. Okay. So what about the execution failures part of it? So this is where you have a setup, you have a strategy, you have a trading model, you have an approach. And we talked about these, in January, and this is kind of leading up to this, kind of giving you the strategies and different ideas. So you can pick and mix what's going to help you. And we're kind of going through the journey now. But you're in a process where you go, okay, you know what? I jumped the gun a little bit. I chased my entry. And maybe I moved my stop when I shouldn't have. I kind of sized up too big, I hesitated, I didn't take it, and then I ended up revenge trading. Didn't take the kind of rally because I thought it was too much. I misinterpreted stuff, I overanalyzed it, I put emphasis on this, blah, blah, blah. We've all been there. It's the nature of the beast, but it's important that we recognize that it's an execution failure and not a standard clean loss. There's the two things so far, third in a moment. So differentiating between the two, stuck to my gun, stuck to my process, stuck to my plan, stuck to my idea, great. Took the trade, lost, versus second guessed it, took a trade I shouldn't have. That's a complete execution failure. The good thing about that is you can fix that because that's a habit. There's more of a psychological aspect, and we will talk about that at some point. But I've covered this many times before. Okay, if you identify, we're basically looking down here. We've gone in the weeds before, like, okay, why are you hesitating on a trade? Why you're revenge trading? How do we avoid FOMO? All this type of stuff. Now we're stepping back and saying, okay, well, not every loss has to be because of FOMO or a revenge trade. No. That's only this certain bucket, this execution failure. And the good news is you can fix this, right? We've talked about ways to, drills to try and help you overcome this. And, a lot of that comes down to what we mentioned before with Bulletproof Trader, right? Is recognizing the emotion is normally it's polluting the decision. And so, if you don't have that self-awareness to say, I'm a little bit annoyed at those previous two trades, and that's then coming into this trade, and this is the trade that you hesitate on because you're worried about a third loss, then having the self-awareness and going down that rabbit hole of self-improvement and focusing on that is the way to fix execution failures. But let's step back a little bit for now. So what I'm calling structural failures. And listen, this is, and at the beginning, when I said things are not black and white, is because it's not easy to put a loss in the bucket, each of these buckets, 3 buckets. I get it. I understand. I can sit here and say, I understand, right? It's not obviously clear. A loss doesn't go ding, that was, now sometimes it's obvious. Sometimes you're like, well, I jumped the gun there. I normally wait for the bar to close. My plan says to wait for the bar to close. I didn't. That's an obvious execution failure. There's no problem with that. But, how do we differentiate sometimes between the 3 of them? I get it. It's not always so clear cut. So structural failures, your execution is good. You follow the rules, but the setup itself has stopped working. Maybe the conditions have shifted. Maybe volatility expanded, contracted. Great. kind of analogy now, the market's just shifted gears a lot, right? One day we've got mega up day, mega down day. There's no real rhythm. And if you are a breakout trader, momentum trader, this is not, if we're talking about the NASDAQ, if we're talking about Dow, this is not the perfect environment for you. If you're a range bound trader, may be different, right? So the behavior that created your edge, and sometimes you just learn from experience and you've learned to do something, maybe it's just not there. And the problem is, and this is why I kind of put this in this box, and you know, and I get this. This is the grey. This is the grey area. Was very difficult to kind of know. And this is screen. And I appreciate this where screen time comes in, right? Experience, judgment. Never get it always right, but you're trying to get better at this. You don't know if it's a structural failure or a clean loss, and you can go weeks without. You can say, "Hey, I did it exactly as I should." Maybe it's just the natural flow of the losers. I'm sticking to it, and you're not looking at the bigger picture and saying, "Hang on a second, the conditions have shifted, the volatility shifted, the trending environment shifted, the expected range has shifted, you know, how we behave off the open has shifted, the response to news has shifted." All these little things and nuances, and we talk a lot about context, and this is why, because it bleeds into everything you do as a trader. It allows you to use the right tool for the job. Hey, you're an explosive trading environment. Well, yeah, you mean reversion, you can do one because I'm going to trade momentum ignition. And also bleeds into things like this, where you can now say, hey, I've been trading a certain style, a certain approach, and actually the conditions have shifted. Very often when I work with traders, I look at traders, I go, say, hey, show me your blotter. And we kind of see the equity curve, and they say, well, it's not working. Okay, well, look, if you overlay on that a chart of, say, the NASDAQ, if you're trading NASDAQ futures, or you're trading stock, or your CFDs, or spread bet, whatever it might be, look, you know, there's no coincidence that actually your equity curve goes up when there's a trading environment. You might not put two and two together, but actually very often it's true. And now you're flatlining or you're giving the stuff back because the market's just in a breather mode. It's just in a doesn't know what the hell it's doing mode. And that's okay. It just means you don't operate that strategy and style in this mode. And sometimes doing that, if you are in a position where your equity curve is stagnating or things aren't happening as the way they should, then one thing to just do is to say, well, have the conditions changed? Look at the daily chart. And you'll be surprised. Very often you just go, geez, well, look at that. My best months are when we have these kind of extensions and we have these big days and we have a one-way street. I just hadn't acknowledged it because I was trading this, which is a subset of a trend momentum strategy, but it's just been working well. So it's worth doing. And then it's worth saying, okay, well, what do I need to see? And then you can qualify that, by the way, and you can say, well, actually, I need to see a breakout of highs before I start to go back in with this strategy or style. And again, there's no hard and fast rule here, but this is your job as a trader to build this up. Same slide, different slide. Okay, so think about this. You've got three traders all sitting there. Let's call them Tom, Dick, Harry, if you like. And they all take a 1 hour loss. Same setup. Trader A, call him Tom, followed the plan perfectly, clean loss, done, moved on, not a problem, no big deal. Let's call him Richard. Richard, he second guessed the entry and he got taken out too soon, right? We've all done it. We've all been there, done that. This is what the kind of the trading psychology aspect is, but that's an execution failure. That's a behavior fix rather than anything else. Same loss, same 1 hour loss, exactly the same thing, but look at the difference. And then trader C, where was he? Harry, he's followed the plan absolutely perfectly. He's done what trader A has, followed the plan perfectly, but now he's started to recognize, hang on a second, I'm getting multiple losers here, and it's not normally what I've had before. I've been operating this strategy and I've operating this specific approach, and it's just not working. And so something may have changed with the market. Now, I understand and recognize that sometimes you're going to have periods where the approach you're taking is going to flatline. You shouldn't just pull the plug on something because you get a couple of losers in a row. We'll talk about kind of sample size in a moment. If you're trading something and you have a little bad run, you need to kind of go, well, that's probably part of the game. And this is where I say it's very difficult sometimes to judge, is it A, is it B? Now, is it A, is it C? B is quite easy. You know if you followed your plan or not. You know if you jumped the gun. You know if you varied from stuff and you go, I really shouldn't have done that. I kind of did it. And sometimes you get a win from it as well. And by the way, you should also note that down and go, hang on a second, that was just luck. I just deviated from the plan. I didn't stick to what I was supposed to do. I'm flying by the seat of my pants, and I got away with it. All right. So be careful of that. So B's most of the time obvious. A and C are very nuances are slightly more discreet, shall we say. So same P&L hit, but you've got a different response required. So let's look at a kind of example that everyone knows and loves, and kind of so we can frame this in our mind and start to think how this might look operationally day to day when we're trading. Okay, so opening range breakout. Those of you who don't know, we kind of bracket the opening range, let's say 15-minute range, high, low, breaks the high, we go long, breaks the low, we go short. Done a big write-up on this. I think it's a very good strategy, can be super effective in the right conditions, but it's one of those trading strategies that has periods where it just doesn't work and has periods where it just knocks it out of the park. And really the edge with the ORB isn't the kind of rule-based nature of it, is knowing when to trade it. And I don't want to go into an ORB talking about the opening range breakout so much per se here, trying to get comfier, but that's really where the edge lies, is when you deploy it. And actually Toby Crable there, he talks about a lot in his book, and I've kind of shared some stuff from my findings. Did I do a webinar? Yeah, we've done a webinar on opening range breakout. So no, by the by, could be anything, could be moving average crossover, could be anything that's rule based, don't matter, don't care. But imagine you have been trading this, it's been your bread and butter for months. Dunk, 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 few losers, few winners. Look at your equity curve going in the right direction. Nice. But the last, say, 20 trades, it's just not working, right? Not really getting the same results that you had before. And so what do? Now, most traders at this point go, well, it's not working. ORB is useless. And most traders come and they report, well, I tried opening range breakout, it didn't work. Or other traders just say, I'm so stubborn, it's got to work. I've been told I've got to stick with the system and keep going. And they just keep bomb, 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 bomb. And they give back all the profit. And you have this feast and famine on your equity curve, right? You do really, really well, then give it all back. Really, really well, give it all back. Because you're just trading the same thing, the same thing, the same thing. I think most traders tend to just flip-flop. So they do the ORB, works quite well, then it's not working, they go, it stopped working. And they go, oh, it stopped working, mate. Well, what are you trading? No, well, I'm trading this strategy. Okay, great. And actually, the answer is not necessarily to dump it, but just to analyze what went right. This guy, Crable's been trading the opening range of breakouts since the 60s. He's got a hedge fund now. I'm not saying the hedge fund trades the ORB, but I'm sure it's part of it. Opening ranges, there is edge there. Or not always no, but there is edge there. Same with a lot of strategies, exhaustion strategy, reversion strategies, VWAP magnet, afternoon breakout, 6 o'clock, all these stuff, they all have edge, but under the right conditions, why context is so important. So imagine you do train the ORB and this is happening. So what are the steps that we do to try to diagnose what the hell is going on here? The first thing is you've got to make sure that you haven't got these execution errors. So let's check that, because B is the easy thing to find out. So we go back and we say, right, 20 trades, did I stick to the rules? Did I chase? Did I tweak? Did I adjust? And last week we talked about this creep that sometimes comes in. We're trying to match a strategy with your type of personality and who you are, and you've got to be very careful. We talk about good traders, good strategies. Sometimes there's a mismatch, and that's because we get operational creep. We start to add layers of rules in that now looks very, very different over a week period than it did in the beginning. So think about this. Did you enter at the breakout level? Did you only go stop every time? Consistent sizing? Did you cherry pick based on a hunch that wasn't part of the plan? Now, I'm more a big fan of putting intuition into your plan and saying, okay, I've got an intuitive element there of the plan, but recognize that that's a variable. Were you even trading, the right session? Were you kind of expanding the opening range breakout? Were you, was there something just wasn't the same? And this is where you could, if you find there's a problem, and you look back and you have to be honest, you have to put your ego to one side, you have to go, you know what, man, look at half those trades, I didn't take it. I thought I knew better. Let's be honest here. I kind of second guessed it. I've been doing well out of it, and I thought I could get more by going a little bit earlier, or I thought I could do a bit more size on this, and I hadn't really planned to. I moved the stop up when I shouldn't. I took whatever it might be, and you've got to be honest with yourself and go, okay, that's probably an execution error. Easy fix. Easy fix. But again, it's being self-aware enough and having these different hats on and saying, right, I'm the execution trader, and now you're the CEO of your trading business, and saying, hang on a second, I need to observe why this business is, why this location, if you like, is not doing as well as it was before. Okay, look, we're doing not sticking to the systems. We're not upselling the large juice when we're going, not upselling them a cookie. We're not doing this, whatever, a rough analogy here, but you get the idea. It's the same type of thing. This little profit center that you've got, ORB, is it not working because the system's not being applied, or is it something different? Okay, so that's a simple one. Right, now we want to check for this, what we call structural failure. So if you've been executing correctly and you've been following the plan and you've been in guidance with the way you trade and the plan and the system and stuff and the model that you have, now you've got to look at the market. And this is where you've got to say to yourself, hey, hang on a second. Have things fun. And a good litmus test is this. Is to just look at the market you're trading and go, does the chart look different? I know it's simplistic, but that's what I do. I say, does anything look different? We don't have to go crazy now and find a data point that's adjusted. The ADX is now below this. Just look at the chart and go, have things, well, maybe they have. We know the opening range needs a breakout. That's the name of the trade. The ORB opening range breakout. It needs a breakout. It needs that reasonable width of open, and then it needs to have expansion after that. So if we have a crush in volatility, the ATR's dropped, the market's kind of gone choppy, then you'll probably get the open a little bit more and it rolls back. And if you're still pushing it and pumping it away like you were when it was kind of breaking out and we're having like a big old rally and a reprice and a tariff thing about, or whatever it might be, it's very different environment. Same market, different environment. You know this, I know this. The context matters more than anything. And so are you seeing these false breakouts? Has the character of that opening hour, opening 30 minutes changes? Are you getting these gap and goes that are just sitting there doing nothing? This is the gray. This is for you to decipher for the model that you trade. I've used ORB as a kind of very simplistic example because it's rule based. But you may have a process that's, a guidance, an idea, a structure. It might not be such rigidity. It might not have such rigidity as the opening range breakout does. But you've still got an environment that it thrives in. If you're trading momentum ignition, you need that breakout environment. You need that volatility expansion environment. If you're trading mean reversion, you need the volatility crush. That's just exhaustion. So it just takes, again, I can give you guidance, but your job, you're the master of the business. You're the master of your trading. You sit there and say, hey, am I trading something that really shouldn't be? We've talked a lot about this, guys. We've talked so much about matching the style and strategy with the context we're in. We talked about the personality, put that to one side, assume that's all locked down, but the context is so important. And in the context, you can be pretty rough with your execution and get away with it. If you've got the right environment, if you're trading the right tool for the job, you don't even have to be that good, and you kind of can get away with stuff. You've got a market that's in a runaway bull market and you're buying at kind of dips. This is why some people just do very, very well in bull markets, because you don't have to be that smart. It's dipped, I buy. Well, you might get a double dip on it, but the reality is most of the time you're not going to. And it's the same if this market's sitting in a range, you're selling at the higher of the range, buying at the lower of the range. That's not rocket science stuff. The context is the thing that's driving the profitability and the expectancy of the environment. And I know that sometimes it's not black and white. So I go to a trend or it's mean reversion, and sometimes we get a bit of both, and that's trading. That's the gray in the middle. But just recognize, hey, hang on a second, is my trading style aligned with the context I'm trading? Whether you have got a systematic rule-based approach like the opening range breakout, or whether you have a little bit more of a loose model as such, like, okay, well, I like to do this, I like to do that. You can still use the same test. Am I trading the wrong environment, in the wrong environment? Am I trying to put square peg, round hole? Yeah, maybe you are. Okay, so, and by the way, I should mention this, doesn't mean the edge is gone forever, right? The environment, markets expand, contract volatility, you test prices, explore new prices, backfill. You know how it works. So you have to look at a chart to see what happens. The way to look at this, to say, okay, hang on a second, if my approach is still sound and I believe it to be valid, doesn't mean you have to just discard the whole thing. you can just say to yourself, listen, you know what? It's not working at the moment. I'm just going to stop trading it for a bit until I see something that indicates this is going to work better. Or you add filters for this. We'll talk about more on that in a moment. So the final thing we've got left here is variance. Now, this is tough to distinguish. I get it. I understand. And it's experience that comes in. And I cringe a bit when I'm like, oh, well, you know, if you put more screen time, you'll get like anything. I go back to a drive analogy, right? When you first started learning to drive, everyone was a threat. You were thinking about how you were operating the vehicle. You were thinking about navigating. Your brain was kind of going overload. And then when you kind of been driving for a couple of years, it's autopilot, right? You don't thinking twice about operating the vehicle. You don't think about twice about navigating unless you're going somewhere new. You've already got your tunes on, a podcast on, whatever, chatting away. And it's just, you just doing stuff. And if some danger comes up, you avoid it. If something unusual happens, you avoid it. You kind of get to know the signs. Hey, that dude's going to come cut in front of me. How do I know that? Well, his road positioning is not great. His speed's not great. Maybe the type of vehicle. You've seen him, his behavior before. You build up the picture, and you couldn't pinpoint why exactly, but it's just the experience of being on the road and driving and doing the miles that led you to go, that dude is going to cut me up. So you back off. Sure enough, right across you, no problem. You saw it. He's an idiot. Get on with your day. A learner driver might not have seen that because they're just looking at actual, oh, well, it's just a car. Why would he cut me up? Well, there's signs there. So, you know, experience helps in trading. And one thing to say is just you put the screen time and you start to see, you know what, I've been through this before where actually the strategy is effective, but I think that it's not my variance anymore. It's more they've got a structural change in the way the market's trading. Not obvious, but that's the game. Okay, so back to where we're talking about. What's left is variance. So your execution is good, market conditions are right for the setup, everything's right, but you're just losing. And that's just the variance of the strategy. And I say about the casino model, and you know, we've got a win rate and this, that, the other. The best way to kind of judge this is to look at history, right? If you say I've been trading this strategy, this approach, this is my rough win rate, yeah, and you say, okay, well, if it's my win rate, I know how many losses I should expect in a row. You can either do it mathematically. I'll show you something in a minute, or you can look at your own blotter and go, well, I've had losses in a row where it's been 5 in a row, 6 in a row, 7 in a row, whatever it might be. And if that win rate starts to decline and you are sticking to the rules and you're doing the execution is solid and stuff and the conditions are the same as they were, then you go, okay, well, it's probably just a variance, right? It's no big deal. And this is where, you know, a lot of traders just give up on a system or strategy. There's so many traders out there who have got strategy that they've tried, they've failed. Now, that's fine if you're exploring your style. You say, I tried scalping, it's not for me. I tried this, not for me. But when you like the strategy, it fits you, your lifestyle, the things we've talked about many times before around your existing commitments, etc., then you can, most of the strategies can work in the right conditions. There's not many strategies out there just pure losing strategies. And think about it from a maths perspective. If there's a pure losing strategy that's just constantly losing, then people do the opposite side. This doesn't work like that. There's always a strategy that's effective in the right conditions. It's the game is blending context, the conditions with the strategy. And if you can get good at that, the rest kind of falls into place a little bit. Okay, so I put into Claude, actually, not ChatGPT this time. I said, okay, for a 40% win rate, what's the probability of a losing streak of 7 or more in a row? Because that's the time when people start doubting stuff, right? You go, 7 losers, man, Jesus. I'm down 7R. Yeah, and if you've got a 40% win rate, and I've got some other tables in a moment, look at this. If you do 200 trades, which, you know, could be, I don't know how many trades you take, it's going to happen. 80% chance it's going to happen, right? 100 trades, 50-something%, 50-50 coin toss, probably going to happen. 25 trades, even that's sitting at like 15 to 17%, which is not a lot of trades. You know, if you think about how many trades you take, the chance of that 7-loss streak and a 40% win rate is pretty high. And if you look at the numbers, when we go 40% win rate, 50% win rate, 55, 60, and 70, you can see this is still quite high. And actually, I want to talk to you about the win rate in a moment. But the point is, if you're trading an opening range breakout and it's a 50% win rate, but you've got, you know, the RVR makes up for that, you get 3-1 on the winners type of thing, then if you trade that 100 times, you got 14% chance, 20, and this is 7. Like if I didn't put in 5, it would be way higher, these odds. 7's quite a lot. But 7, I thought that's quite extreme. People, tend to second guess things after a 7 losing streak. But the point here is that you could still have an absolutely lovely system. And if we took all the variability out of it and said, this is the win rate, this is this, and you just run it from pure mathematical perspective, you can still be looking at this and go, a 7 losing streak is some probability there. It's not an unusual event. And you can see how it varies. And actually, why I wanted to add 7% win rate is, we talked about win rate and RVR, adjusting those two dials, if you like. Look how much it affects the probability of having a losing streak when your win rate is high. One thing we mentioned is the psychological benefit of having a high win rate, because you don't get so many losers, you don't get you feel good from the winning, and you kind of you forgive, or you what's the word I'm looking for here, the flip side is that you don't get the same reward when you win the trade, right? But look, you go from 50 to 60, the probability of having a 7 loss streak in a row is massively different. So that's worth thinking about. If you're adjusting win rate, then a little tweak in win rate and giving a little bit back on the RVRs, how much you're making for how much you're risking, mentally can be so much more soothing. So look at this. Even with that 50% win rate, I mean, you can see the numbers here. I don't need to go over this stuff. This is why it's important to have risk management. It's why it's important to, make sure that you've got your position size dialed in. This isn't a conversation about win rate and expectancy, but the point here is to illustrate that you could have a damn good strategy that's effective, that just by the nature of maths is coming up and giving you that losing streak. Okay, so once you've diagnosed, what can you do? You've got execution failure. Easy enough, right? You just tighten your process, you work out where the execution is failure coming. Are you hesitating? Are you FOMO? This is a discipline issue. This is a psychology issue. We can go down that. We don't want to go down that rabbit hole, but that's there to be fixed. Go all in on that. If it's a structural failure, pause the setup. Just stop and go, hang on a second, the conditions have changed. Eyeball it. Look at it. Look at ATR. Look at volatility. Look at things that affect the way that you trade, and then go back and say, have things changed? Yes, they have. Pause the damn thing. Don't throw it away. Pause it, or add filters that say, hey, I will only trade this under these conditions. For opening range breakout, we talked about things like, okay, after a 2-day pullback, I'm only going to trade it to the long side because we're an uptrend, but we're bouncing around the kind of mean, whatever it might be. Add a filter to try to align the right conditions with the right trade. If it's variance, do nothing. If you're trading right, you're executing correctly, the market looks the same as it has been before, just be smart and just say, listen, this is the way it is. Remind yourself, go into ChatGPT, go into Claude and say, hey, what's the odds if I've got this win rate? Go and get your win rate from your blotter of having 4 losers in a row. If you had 4 losers in a row, and it might say something like, yeah, you got a 40% chance. You go, well, should I really be bothered about it? No, the market conditions are the same. I'm executing as I should be. It's in line. It's just the way that it's coming out in the wash. And you just have to. It's a hard thing to do because often you go, oh, I want to fix it, and traders are very focused on like the now very often, and actually it's far better if you can kind of future pace where you're headed. But you some things you can't fix immediately, and so one loss tells you nothing, right? And this is what I said before. It's like, I don't want you to take it literally like, oh, well, one loss, I need to look at this. You want to look at a cluster of losses and look at the pattern. And so this is why we kind of look at multiple trades, 20, 30, 40, 50 batch of trades. And we say, well, what does the loss cluster look like? Is it healthy? As in, if you are trading different strategies and setups, am I having the losses just clustered around? It's quite random, and it's probably okay. If I have this really big cluster of losers that are in this particular strategy, in this setup, in this market even, then there's something wrong. There's something wrong there. And so when we're digging into losers, we want to be very smart and say, hey, which of the buckets is it in, number one, and is it a signal? Is it noise? And should I do something about this? Is it just the variance of the strategy I'm trading? Am I screwing things up, or am I trying to trade something that is just really not the right conditions for it? So repeating myself here, I don't need to. If you're getting this cluster of losses that looks pretty decent and looks pretty normal, don't do anything. If it's you're getting a real kind of, there's people who are trading multiple strategies, by the way, getting a lot of losses in one place, then you need to look at it and go, hang on a second, what's going on? Am I second guessing things, or has the conditions just changed? And one thing I put here is think like a CEO. Don't do anything knee jerk. The problem I think with many traders is we make too many corrections, course corrections. I was talking to a trader earlier on actually, and I was praising him on his ability to stay the course and not deviate from his system and strategy. And he goes through periods where he just doesn't get anything, right? Here he gets a little loss here, and the way he structured his system is that he makes kind of 6R, 7R, that type of thing when he wins, and he loses 1R, slightly less sometimes when he loses because he moves the stop a little bit. And I said to him, listen, you're very good at recognizing when you just need a little adjustment. If you're the oil tanker's moving off course, rather than just going full to port or starboard and then having to overcorrect and doing this, you're like, hang on a second, I'm looking miles ahead. I just need to adjust very slightly. Conditions have shifted a little bit. I just need a tiny little correction, knowing that over time, that's going to put me back on the straight and narrow. And many traders like jing, 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 zigzagging back and forth, making these massive adjustments. A CEO would not change the business model dramatically for one bad week, for one bad month. They would look at it and go, hey, is there a pattern here? What's happening? And if we use that analogy of, let's say a cookie shop, right? Whatever, a cookie shop, he's got loads of different locations. He looks at one store and he goes, hang on, why is that not performing as it was last year? Is there a reason for it? Well, let's just first go in and make sure that the training is up to standard. Are we upselling the bigger cookie? Are we, showing customers they can get 5 for the price of 3? Whatever the hell is, are we adding toppings that are our big? You get the point, right? Business, that's business. Okay, is that okay? Fine. Next thing is, has something changed? Something shifted? Oh, hang on a second. There's a massive luxury cookie store open 2 doors down. Okay, the regime's changed. I need to do something about this. That's obviously that we're not in the same conditions that we were last year. Oh, hang on a second. The footfall of the center we're in has changed dramatically because the parking's suddenly 20 quid in a minute, whatever the hell, right? You get the point. I'm going off on a massive tangent here. You get the point. As a CEO, your job is to diagnose and adjust. Or is it like, hey, nothing's changed, everything else is fine, it's probably just a blip in the system, I don't need to do anything knee jerk? So just think about this. Now, this might sound backwards, but just bear with me for a moment. Losses, when they're within your expected parameters, your maybe normal win rate, your normal drawdown range, that's fine, just the way it is. But the thing is, you need to just look at the way the losses are coming out in the wash and say, okay, listen, these are pretty much as I expect. And that is where expectations come in as well. It's like, I can't expect something major. I'm not expecting like 100% win rate. This is probably what I expect. What's my win rate? It's this, that, there, seems all right. You kind of go, well, I'm probably on track. Don't need to make any adjustments. But if you have that win rate drift compared to your history, if you have like the average losses creeping, you have the drawdown, it's getting more than you have done when you were trading it previously, or back testing. This is an important point, by the way. If you're kind of a developing trader and it's a new system, you just don't know, I've got no data to look at, you go back, and this is where you do manual back testing. You say, hey, I would have taken that trade there. That's the thing, you log it. Traders do that. Some traders are very good at sitting there and manually going back. When did that pattern occur? What was the outcome of that? What was the outcome of that? And so you can still get data on the win rate of the system or this process without actually having trading it. Better if you've done a live and you've got the data there, but actually you can still do that and go back and look for yourself. And so just think, if you've got one of these, maybe not so bad, but if you're getting all 3, then you probably have to do something. All right, so this works. It only works if you're diagnosing your losses, only works if you're tracking. Very easy thing to do. After you're losing trade, you just put one tag. You say clean, execution, structural, right? And this is you guessing, making an estimate of how the loss came about. Most of the time, excuse me, most of the time it's going to be clean. Okay, it's normal, but sometimes you start to say, wait a second, this could be structural. And when you start to tag it, you can go back then and look and go, you know what, my hunch is right. I think that I traded this in the wrong environment. Even though a plan said to trade it, I just think it wasn't right. Execution is an easy one. And now you can start to look at the data. Losses aren't just a massive thing that you kind of wade through. You can look back and say, hang on a second, those 5 losses I took there, I've labeled 4 of them as structural because I believe it's the conditions might be right. Then you investigate further. So you're alerting the CEO, if you like, to potential kind of problems. Now, I say every loss is a message. Most of the time, the messages do nothing. I don't want you to be, driving the car by jerking the wheel like this. That's not how we do it. We want to look at the loss and we want to group into clusters, 40 trades. But every loss starts to add a message. Most of the time, it's like normal, normal, normal. That's the message. Normal, 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 normal. But over time, if you start to see the equity curve not performing as you want, if you start to see the clusters of losers, then you say, hang on a second, I think I'm in the wrong conditions. Or it's me, it's my execution. I'm screwing things up here. And then you come up with the fix and you say, right, I need to not trade this in this particular environment. I need to only trade in this environment, or I need to fix my head because I'm second guessing stuff, I'm hesitating, etc. Like I said at the beginning, we're not overdoing this and looking at every loss and going, oh, I need to analyze that loss. It's the clusters, and every loss stacks up so that we look back on that 40 trades and go, right, how did that perform? Is it good? Was it not so good? Is there something I need to do? Let me think of those 3 categories. Is it me screwing up? Is it just normal at this? Again, very difficult. It's often to judge it. But you've got to make a decision. What you don't want to do, I don't want to see you doing this, just plowing on regardless. It'll work out. Or abandon a system. Be intentional about it. If you abandon a system, be very intentional and say, am I abandoning something that actually has validity and efficacy just because I'm having a string of losers? Or am I abandoning a system because it's a crap system? Very different decision. Be intentional about it. Many traders emotionally go, oh, it didn't work, throw it away, and they do something else. Oh, it doesn't work, throw it away. And then it's just that never-ending cycle of trying different things. This is the point, to stop doing that, be intentional and say, hey, I just need to not trade in this environment. And you go back and you look and you say, well, if I'd waited for this, would that? Yeah, actually, okay, great, fixed. I'm not trading at the moment because I don't have the conditions that are right for me. Okay, good. If it's something else, you get the idea. So intentionality, not making rash decisions, just remembering what Steve Ward said about being very self-aware of your emotions and how you're thinking, because it can impact you on a trade basis, but can also impact you on a broader business model basis or a system basis. And if you throw something away that actually is pretty good, you're starting from scratch. The cookie analogy, the guy goes, I'm not going to sell cookies anymore. I'm going to start selling toothbrushes or whatever, right? He might do a rash decision because he looked at one thing, but actually there's an explanation for it. It just needs an adjustment. The staff need training. He needs to add a different style of cookie. He needs to do this, he needs to do that. Maybe he needs to, you get the point. The analogy is a stupid one, I get it. But thinking of trading like that, imagining yourself as the CEO and being intentional about the decisions. So many traders are making these decisions on a whim, whether it is getting rid of the system, whether it is changing this or changing that. And then you're constantly chasing your tail, and it's not easy. I know it's not easy. I've written an email actually to go out tomorrow morning saying exactly this. It's tough, I get it, but this is the kind of what we signed up for. There's no, things aren't obvious. We have an incomplete picture. The data coming from the charts is incomplete. The data coming from our results is incomplete. Is the system effective? Sometimes we don't know. Is it me? Is it this? It's not always easy, but if we can have an idea of what we're trying to solve, at least we can do our very best to get the right outcome from the decision that we're making, with an idea of where we're headed, our North Star. Hey, I'm trying to do this. Right. I might need to double check this. Context, execution. All this stuff just kind of comes into play. Okay. Let's have a look at some of your questions, guys. We've got a deep one. We've got a deep one tonight. Yeah, I got time for these questions. Okay. Using me for the behavior fix, quite apt, Richard says. Okay. Anthony says, great webinar. Thank you. Appreciate you, Anthony. Here's a quote that felt suitable and I use pretty often. The deadly sin is to mistake bad play for bad luck, from Casino Royale. Oh, yes. Yes. Yeah, very good. Very apt for trading, right? If you're screwing up your trading process, then, you know, it's not the same as just having a string of losers. Yeah, absolutely. And you know what? Some people do. I don't know if it's in Bulletproof. One of the, I think it might be in Steve Ward's other book, or maybe it was Elder's book. That the quadrant of trades that you won and stick to your plan, trades that you won and didn't stick to your plan, trades that you lost and stick to your plan, and trades that you lost and didn't stick to your plan. You know, you don't. Those are pretty much the outcomes, right? And you want to make sure that the winners and losers are the ones that you stuck to the plan. You're not confusing things with others. Driving a beam. Gary says, great concept, balancing win rate versus RVR. Okay, there's a question from Graham here. Can't see the whole question. Why can't I see it? Oh, I can scroll. I'd be interested to know your views on what I refer to as the conditional stop loss. For example, if you open a long position at price Y and put a traditional fixed stop loss at price minus Y, does that not seem not as good as putting a stop loss at price minus Y with conditions that you only accept the stop loss if the conditions are right when it's hit and leave it open if not? For example, if the stop loss... Okay. So your question, Graham, is this, and it's a very good question. You're basically saying, hey, if the stop loss is hit, and I think that the conditions don't warrant me taking that loss, and I will be careful with this, we'll measure that in a moment, then should I do this? The thing here is that you always got to have, you got to be very careful about deciding on the fly whether to take losses or not, because no one wants to take a loss. No one wants to take a loss. However, what you say is true in that if you have a sudden spike that bounces back, difficult to judge, I appreciate. But if the conditions aren't really what you see and you say, I don't want to come out of it, do you really want to come out of it? And this is where you can trade like this, Graham. You can have an absolute red line in the sand. I don't want to risk any more than this, because you don't want to get into the trap of I'll hold it just to see, because the little voice will be saying, well, just see, hold it for a bit more, hold it for a bit more. Before you know it, you're trying to long, you thought it was exhaustion candle, it's grinding lower, grinding lower, grinding lower. That's a count killer. So you have to have a red line in the sand regardless. However, that can be an emergency stop, and you can have a kind of a, dare I say, discretionary stop, where you say, right, I don't really want at this level, but I will reassess the trade. So you've got your emergency stop, that's fine, that's in, locked in, never ever go breach that. But you've got a discretionary level where you say, hey, I don't really want it, but I'm going to reevaluate the merit of the trade at that level. And so when the trade hits that level, you look at the stuff that you're suggesting there, which is where you say, hang on a second, this has just spiked here. Let me just see if it responds with a spike back. If it now continues lower, I'm out. So you have to wait for the red line, but you've got a level where you were kind of making a judgment. A lot of old school prop traders would do this, where they would say, okay, this is where I'm coming out, but I'm going to hit out of it, excuse me. I've got an emergency stop in, but I want to see how price trades to that environment. Example is, if I have a swing trade on, this is my approach, and they're right or wrong. If I have a swing trade on and I hold the trade, and overnight I get an unexpected gap, normally I have a good cushion, so it's rare this happens. If I get an unexpected gap on my trade, if I've got an equity position on, and it breaches my stop loss, or it looks like it's going to breach my stop loss at the open, I will cancel the stop, and I will say, I don't want to get pinged out the open, right? I'm in a losing position, right? I need to accept it. A position size will be adjusted to suit, obviously. I want to see how it trades at the open. If it just opens and just grifts lower, 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 I'll just hit out of it. And I'm going to take more loss than I wanted to, but that's the decision I make. It's a commercial decision. If it starts to trade higher and higher off the open, then I put my stop under that low, and it might be wider than I initially anticipated. But like you see, you're judging it on its own merit. And actually, this is quite advanced, and I really want to make sure that people just do not move stops. Don't move stops. Don't mess around with stops. Always have a line in the sand, because that's when you just end up doing massive damage. But there is a level where you can reevaluate and go, I don't like it, I'm out. Or actually, I still like the trade. The price action doesn't look too bad. Let's see what happens in the next 5 minutes. And you give it another 5 minutes. Now you understand the consequence of that. It could go deeper and it could lose more. You kind of making that trade-off. So I hope this answers the question. That's a really good question, actually. Andy says, thanks again, Mark, for your time. I found it really helpful. Is a question, please. At what point does a loss tell you the market has changed versus you just had a bad day? If you are sticking to the rules, if you have the conditions of and listen, I understand conditions change from day to day, right? Sometimes you have a doji day, sometimes you have an explosion day. You get a doji day in a training environment anyway. So if you try and trade an opening range breakout on a doji day, you know, that's always going to be, you're always going to get the results that you would get with that, which is not very good results. And you know, so you have to kind of look and say, is execution, as we just said, and don't be too quick to make the decision the market has changed, because like I said, the market goes through expansion, contraction, even an uptrend, right? You don't necessarily have to jump to the gun and say the market's changed condition. You just have a losing trade. And then it's very difficult to give you an exact precise thing, but look at don't take one day as data. Take 10 days, 20 days, take that as data and say, hey, because here's the thing as well, you don't, from the flip side, Andy, you don't want to cut a profitable system off because you've had a 1 or 2 losing days. So that's why you always must look at like a big chunk of days, 10, 20, 30 days, because you'll go through periods where, you know, well, it's done nothing today, but then we're back to another leg. Okay, great, the opening range breakout's working. So always kind of accept, hey, it is what it is, load it, log it down, and then after that period where you're looking in clusters, you say, actually, you know what, this does not look great, and that's the price, or it does not look great. Oh, actually, you know what? It's just a couple of days of loss, and we're back on the game. Because that's another thing a lot of traders do. Systems working, it just goes through a really small period of not working, then comes back into play. Listen, if it was easy, we'd just be going, this is the perfect trade for the day. I'll deploy that. Ding, it's worked. You know, this is the real granular stuff of being a trader, guys. It's like, there's no real correct answer. It's like, do I cut it now? Do I let it run a little bit? You can judge that because it's your money, your risk, you're making the decision. But what I really want to kind of get across is that the more you can make the decision intentional, you can say, hey, I don't want to jump the gun. I'm not the guy, CEO, who suddenly changes business model because I've one bad day. And I'm not the guy who ignores one bad day, one bad week, one bad month, one bad year, and just plows on regardless. I'm the man, woman, who looks at the data, who trusts his judgment and says, you know what, things have shifted. I need to make a change here. I can't just plow on and keep expecting it to recover. Versus, I think we're still in the same regime. The market's moving this way. The market's doing this. This is normal. This is normal. It's normal. Stick with it. It's not an easy decision. I get it. I understand. But it's really the crux of trading. Because it was easy. You go, well, I'm going to trade momentum today. Ding, jackpot. I'm going to trade mean reversion today. Ding, jackpot. And this is the heart of kind of making these decisions. But I just think intentionality is kind of one of the big things here. Thank you, Robert. Andy, sorry. Robin says, great webinar as usual. Thank you. I appreciate that. What specific quantitative thresholds do you use to distinguish a normal statistical loss cluster from evidence of structural edge decay? And how many trades of underperformance do you require before taking? I think I've answered that, Robin. And, you know, I don't approach stuff from the real kind of quantitative perspective. And there's probably quants out there and algo guys and real kind of hardcore science guys who will have a number. They'll go, hey, I look at this and I assess it and I plug it into this and there's some statistical formula that spits out, change it. And that's fine, you know. But for me, as a pure price action discretionary trader who relies maybe too much on his judgment, but that's okay because I've got the judgment there and experience that I trust, that I've learned to trust over time. I just go, you know what, I need to just step back. And if in doubt, by the way, step back and peel things down. Lower your position size. Take things back. You can always put the pressure back on. If in doubt, back off a little bit. You can always push it back on. So, you know, the precision, I'm probably not the guy to answer that. There's probably a statistical thing out there that you can map out and go, well, this is the exact point where you stop it. But for me, I don't believe that the markets are like that. I think there's a lot to do with your judgment and your opinion on things and making. I know that's not the answer you kind of wanted, but that's my perspective on stuff. Okay, Felix said, great talk. Really nice meta process you came up with there. Appreciate it, Felix. I think the identifying and framing the optimal context for a given strategy is the key. It is, mate. It absolutely is. Honestly, like it all comes down to that. And you know, I wish I could say to you, hey, if this, then that. But we can't. We kind of look at stuff and go, am I expecting trending? Am I expecting momentum ignition? What do I look for that? And we've covered the, you know, what's the daily chart looking like? We've got a catalyst. What's the overnight range? Where are we in position of the overnight range? What was the prior day? All those things are what will guide you into that day. I'm still struggling with putting down this exactly. Yeah, I hear you. It's the game. It's the game. It's the game. Do you have a personal favorite criteria for the ORB? I strive for something objective as much as possible because context that's mostly discretionary is hard to do statistics on. It interferes with your point 3 regarding variance. And this is it. This is the whole point, is like everyone, we are humans, right? We want to know, what rule do I do this? Under what do I do this? And just think about driving a car, right? There are rules of the road, but there are times when you just do stuff because it's the right thing to do, and your experience is what, you know, if you were teaching a new person to drive, they're like, why did you do that? Well, I did that because the weather, because of the time of day, because of the vehicle that's in front of me. There's just these variables that you know over time. You're like, well, I just did this because that's what I've learned to do over. And I know that's not the answer, but it's difficult to portray this type of stuff to a new driver, right? And so the job is just to keep going through and keep saying, okay, I got experience tells me, hey, this is driven by catalysts at the moment. This is different catalysts we ever had. Trump's second time in power has not done this type of thing before, the tariff, blah, blah, blah. This is driven by this. Catalysts tend to have this environment. Catalysts tend to, whatever it might be. So you kind of make the judgment based on experience there. Anyway, going off on a tangent. ORB, you just want that range expansion. You want that price discovery. A lot of traders, not a lot of traders, I've heard traders who will, let's go back. There's two things here. One is after a narrow range 7 day. So Crable does a lot of this, narrow range 7, narrow range 4. So if it's the prior day's been the narrowest range, the previous 7 days, 4 days, that's a good time to look. I like to kind of look at it and go, okay, when is my expectation of volatility expansion, right? So that could be, hey, have we kind of rallied on the daily, congested for a bit, maybe tested prior day's low, and we're opening up today. My expectation is we break out of that and it's a flag pattern on daily, and I want to use the ORB to express that on the higher time, from the higher time frame to the lower. Others might be, okay, we're kind of oscillating around. I expect that we put in a green day today, I'm going to do that. So we're using the higher time frame stuff to trade the opening range breakout. And then the other filter to use, Felix, here is you don't want it too much of a big range. Like if you have a massive opening range, some criteria to say, you know what, that's too much, too soon. And that's when you look at your stats, you know your market. You say, how much do I expect the market to move in the first 15 minutes, 30 minutes, 45 minutes, hour? And then, hey, we're at the higher side of this. There's probably not much meat on the bone there. And by the way, you know, a lot of those questions are expected, like, okay, what's the rules for this and the rules for that? And I'm in the same boat as you guys. It's very difficult to have this subjective nature. But, you know, you look at any of these great traders, Pitbull, you look at, where is he? Jesse Livermore to a certain extent, whatever you think of the guy. You know, there's that element of trust and judgment, and there isn't like a completely binary black and white thing. It's this gray area, and that's screen time. And I know it sounds flaky, but and you never know for sure, right? You never know for sure, but the screen time will say, well, I don't think it's this. I'm going to trust my judgment on that. Paul says, thank you, enjoyed the session as always. Appreciate you, Paul. Toby says, brilliant stuff as always. Redefining losses, everything in trading. Will the recordings be available? Yeah, they'll be up soon, Toby. They'll be sent out to you when they are edited. Thank you for your feedback, pal. Two more questions and then we'll call it an evening there. Jangir, how you doing, Jangir? During these periods, would reducing your position size and risk be a viable strategy? Great seminar. I never thought of this before. Thank you. Thank you, Jangir, for your feedback, pal. Yeah, absolutely. If in doubt, peel back the size, because you don't want the emotions to impact how you then trade. And if you're worried about it, you then start second guessing stuff, you overload the boat, you do this type of thing. So you use size as an emotional amplifier or reducer. Is that the right word? And size often does that. So if in doubt, like reduce the size. If you're more experienced and you go through and you go, you know what, I can stomach this, it's fine, no problem. But if you're worried about it and you're kind of worried about losing more money, then reduce the size, that's fine. You might look back and go, hey, I've got a pattern of reducing size just when things are starting going. That's the danger a lot of traders do, is they have a good run, starts to not do so well, they reduce the size, and then they're too late to put the size back up. And actually the recovery would have been with the bigger size. It's not always like that, but that's something to consider. Foyle says, do you have any templates for diagnosis you could share? Can we use Trading Plan Pro for the 3 types of losses? Yeah, Trading Plan Pro, you can edit this spreadsheet because it's just a Google sheet. You can go in there and click on the little what is it, pen icon, and you can change what you track. So I know its default is to frustrated. What's the other ones I've got in there? Because I've changed mine, but you can change them. Yeah, so you can kind of change the what's in there, and then that will update on the charts. Edward says, great session, thank you. Right, thank you, ladies and gents. Foyle says, nice, thank you very much. Thank you all. Appreciate you all, ladies and gents. Interesting one this evening, I know, but hopefully you find it valuable. Back again next week. We are, same time, same place. Let's keep moving forward. Take care, guys. Bye-bye.